Wow. Housing crash incoming as Moody's downgrades the United States credit rating, citing growth in government debt. Moody's was the last agency not taking away the AAA credit rating for the United States. S&P and Fitch have already done that. Countries have credit scores just like we have credit scores as well. Now, what this means right here, the fact that Moody's has done this, is that it's going to cost more for the US government to finance our national debt because credit just dropped, meaning the interest rate that we have to pay is higher, costing us a ton and ton of money. Now, this also has big impacts because now the US government has to offer higher returns on the 10-year and 20-year treasuries. And what this means is, if you take a look here to the right, mortgages are now having higher interest rates. We're essentially back to 7% over here if you look to the right. And we know every single time the housing market sees 7% interest rates, it comes to a standstill. Buyers start abandoning the housing market. And in 2025, it's already been abandoned and it has not recovered. If we take a look at the inventory, we see that inventory is much higher in 2025 than any of these years. If you take a look, we still have months and months of inventory growth left. Here in 2022, you see this inventory growing substantially higher than in 2021. And this is when we saw prices drop upwards of 15% in the greater Salt Lake area, 10% nationwide, and only two metros did worse than we did, Austin, Texas, and Boise, Idaho. Now, if this inventory continues doing this, continues increasing, we could potentially see prices dropping in the second half substantially like we did in 2022. We just got our credit score rating downgraded, which means the can kicking that the US government has been doing, the amount of money printing, is potentially going to have to stop. And all of this is happening as the debt time bomb. Corporate borrowing could cripple the economy. I'm going to dive into this. I'm going to dive into other things that I've been mentioning in previous videos, but I'm going to lay it out in chronological order and why this is going to impact the economy and the nationwide housing market and our local Utah housing market. Before we dive into that, smash that like button. Nobody has your back like Dinko the Realtor. Subscribe. That'll also help the YouTube channel, but it'll also help you to stay up to date with what's going on in the housing market, with these articles, with the data, as well as the nationwide economy, because nobody has your back like Dinko the Realtor. And when you do need a realtor, my contact information is down below in the description. Give me a call. Let's strategize and make sure we get you the best deal. If you're a seller, we can make sure we time the market, get you top dollar. If you're a buyer, I'm going to help you strategize. I'm going to help you take advantage of the housing market. That way you get the best deal based on the data, based on information, and you make the best deal for yourself, the best decision, right? Now, if we take a look at this, the time bomb, and I'm actually going to dive into this here, but also the commercial real estate maturity wall that they now kicked into 2025. And this right here is the refinance boom that even JP Morgan and Goldman Sachs are saying is going to be just as bad, potentially, if not worse than 0809. And we're going to get into that. But right here, corporate debt has increased to unheard of heights in the last 10 years because of the low interest rates. They encouraged excessive borrowing. Right here, corporate debt threatens the world economy. Unchecked, it might be the inputs of a major downturn. Companies like AT&T and American Airlines, these are not little companies, are struggling with the enormous debt loads threatening profitability and refinancing expenses as refinance expenses rise. And if you come down here, companies have profited from historically low interest rates. Right here, essentially near zero interest rates for the past 10 years. And this exceeded, this corporate debt, $11 trillion by 2023. What is it right now? I haven't been able to find an update on that. And all of this high debt, industries have been particularly vulnerable. And the tech sector is in here. I've been talking about them. And right here, high growth companies like Netflix in the internet sector have depended on borrowing to drive their growth, therefore exposing them to increasing interest rates. They're essentially, right here, they borrowed money. They used it for mergers, acquisitions, and stock buybacks. I mean, that's essentially manipulating what's going on in the housing market. These cheap interest rates for the last decade have fueled this boom, and I've shared an article in the past. 5% of tech companies in 2021, this article was in 21, stated that only 5% of tech companies were actually profitable that were valued at $1 billion or more. In 0809, the Great Recession, 2008-2009, we did not have a tech bubble because we had the dot-com bubble of 2000, and people were skeptical of over-investing in tech stocks. Well, that has not been the case here lately, and these companies haven't been profitable, and they've never been through a recession. A lot of them haven't. That's something to keep an eye out on, as interest rates are now rising because our credit score is getting downgraded. So the US government is going to have to stop printing this enormous amount of money. Right here, the Biden administration extended this FHA mitigation until the 30th of April. It was supposed to end on the 1st of January. And then the Trump administration on about April 20th extended it to September 30th. However, they are stating that they potentially are not going to be able to keep extending this. Now, they are going to work and try to figure out some plans because of the taxpayers. They're going to have to, they probably knew that this was coming, this credit downgrade. And all of this is happening as commercial real estate maturity wall of $950 billion, $1 trillion essentially in 2024. And I've stated this in a video. They kicked this can that was supposed to be at the end of 24 into the end of 2025 here. And now this peaks in 2027. So here at the end of 2025, we have over $1 trillion of commercial loans that are due. And commercial loans are different because commercial properties are more sensitive to interest rates than residential properties. The overwhelming majority of commercial mortgages are variable rates. Variable means it's not fixed for 30 years. These interest rates increase. Also, these rates are fixed for only 1 to 7 years. And then they adjust after, which means the cash flow of commercial properties will be impacted much sooner than residential properties that could have a 30-year fixed mortgage. Now you have a time bomb of the corporate debt and of the commercial real estate debt. And right here, if we take a look, the debt refinancing woes, this right here is going over the corporate debt. Companies are being driven to refinance their current debt at far higher interest rates, and once inexpensive borrowing became a financial burden. This is greatly reducing profitability. Now, not only is it reducing profitability on the commercial real estate sector, but in the corporate sector, so the corporate debt and commercial real estate. And then to make things even worse, like I've been talking about this, car repos hit the highest level. This has not been seen since 2008, since the financial crisis. Everybody wants to say everything is looking peachy and dandy, but it's not. You actually have many more bubbles right now than you did in 2008, 2009. And that's why they're probably terrified and continue, both administrations continue kicking this can down the road, continue printing money, and everybody is adding to the national debt. Trump did it in his previous term. Biden did it. Obama did it. Trump's doing it again now. None of these politicians have our best interest, and that's why our credit rating by all three credit bureaus now has been downgraded, causing interest rates to go up higher. And we know that the car industry, the housing market, commercial real estate, corporate debt we just went over, they can't handle these higher interest rates. And then if you take a look here, look at these active listings. What's indicating that this is going to stop increasing this enormous gap that we're having year over year, resembling what we saw in 2022 compared to 2021. And the nationwide housing market in the second half of 22 saw a 10% decrease in home values. And in Utah, in the greater Salt Lake City area, we saw a 15%. Only 2 metros performed worse than us. Well, we're resembling the talks about a recession, the issues with interest rates, the issues with the commercial real estate sector, the issues with the corporate debt, inventory growing. All of this is increasing. The debt, the interest rates. I want to hear your comments down below what you think is going to happen. And look, I've been saying the best deals are potentially going to be coming here in the second half of 2025. Hit me up. My contact information is down below. If you're looking to sell, give me a call. I'll help you get the best price. And if you're a buyer, I'm going to help you with this data, show it to you. That way you can pick and decide when it would be best for you. What month, what year. I don't care if you want to wait until next year or if you want to take advantage of what's coming here in the second half. If you take a look here, you're seeing that if this continues increasing, you're going to have much more to choose from, much more leverage. And I've been saying, wait until Memorial Day weekend. That's when the market's going to start flipping. 4th of July is when it's going to be flipping even further if this inventory continues growing. And then when the school year starts. Those are your 3 markers. And then, of course, when the holidays come around, but then inventory starts decreasing and you have less to choose from. So give me a call. Let's go over this information and see what the best time would be for you, depending on what you're trying to accomplish.